Hey guys and gals, I made 3 simple trades from my phone earlier today using this rule, and I'm going to teach it to you right now. I'm just fucking. Oh my god. Fucking mosquito. So, a little bit of backstory today. About 30 minutes ago, I did this same video. And, forgot to hit record. So, we're going to do it again for the second time. So, yeah, here we go. Hey guys and gals, my name's Joe Kelly, and I'm going to teach you one thing today on how to trade from your phone in order to become consistently profitable. Check it out. Oh my god. Okay, all right. Okay, I'm gonna be serious now. I promise. Here we go. So, today, for the second time, here we go. Today we're going to talk about what I call the 1/5 rule. Okay, so the 1/5 rule is a scaling method I use in order to spread my orders out and determine my size. So I like to use the 1/5 rule in a couple different scenarios. So in the scenario I like to apply it in the most is on low hanging fruit plays. So low hanging fruit plays can be things like, let's message this off to the side here. Be something like a former runner. So a former runner is going to be anything that ran in the prior, it can be years. It can be years ago. That was a former runner. It can be months ago. It can be weeks ago. It can be days ago. My favorite ones are the days ago plays. It was a former runner a few days ago. And I like to apply the low-hanging fruit strategy that Bao teaches, and I use a 1/5 rule for the scaling. And what I want to explain is the scaling method and using the range orders, because I saw a lot of questions today in the mentoring Q&A, and a lot of them had to do with risk management, and a lot of them had to do with stop losses, and a lot of them had to do with anything and everything regarding preservation of capital. It wasn't, going out there and finding a pattern or whatever it is. It had order entry and preservation of capital and all this other stuff. So what we're going to talk about is the 1/5 rule plus the low-hanging fruit. And, these are plays that are former runners. And I'm going to show you a little trick on how to keep track of those. So here's how I explain the 1/5 rule. So let's take, for example, this triangle right here. And let's say that is the move that we are focusing on. And the ideal level is not that red line, because that doesn't help much. It is this black line right here. So the ideal level is right above this black line, okay? And now, let's say this level on the left side over here starts at, let's say, like 335. And it goes up to, let's say, at the top here, it goes to 350. And it gets to 350 at the top. And then there's a wick. You're looking at the line chart, and this is, what the peak looks like. It's, so 350 is the top of that peak. But on a line chart, the way it's calculated is it's the closing price during that time frame. So if it's a 1-minute chart, the reason why you use 1 minute is because it feeds in more data and your line becomes more accurate. If you use a 5-minute line chart, it's a wider average, and so the chart doesn't get as accurate to the wicks and everything. And so the 1-minute average close is, let's say it's 350. That's the peak of the line chart. But if you look at the candle chart, because you should use candles combined with line charts, because let's say that there's a level at 350. But above 350, you saw that it went parabolic above there, and there's a big wick hanging out. And that wick, oh my, won't go straight. There we go. It went all the way to 350, and then the wick went all the way up to 370. So let's say this is the application you want to use. When I apply the 1/5 rule to a trade, here's how I do it. I look at the range in which I would like to start shorting, which would be anywhere in this range right here, okay? And notice, I'm going to point something out to you. I do not split orders over here and then over here and wait for confirmation. I don't do that. If I want to add to a winner, I've got to realize a piece of profit first. That's a winner. That is a winner. A winner that is all unrealized gains is nothing. It is nothing. It is a no trade bet. It means nothing. It's the age old thing that, you know, I can't lose if I don't sell. So it's not a loser. It's not a winner if you don't sell either and lock in any piece of the profit. So you've got to lock in some profit before you can add back what you previously covered or sold. So this is the range that I'm going to add 335 to 350 up to 370. Okay. And the 1/5 rule is simply this. If I start a position and my starter is equal to 100 shares, then that means my overall size will be equal to 500 shares. See, 1/5, right? 500 divided by 5, 100, right? So 1/5. I let my starter size dictate my overall position. Now, there are times when I break that rule, but that is on the back side on confirmation. When I'm shorting front side of a move, which if you guys saw Aloha's video, it was front side shorts need front side covers. Front side can be very dangerous. It can get you really squeezed. But if you size appropriately, you can keep your risk under control, or you can just size the front side of a spike that's on the back side of a move, which is the low-hanging fruit, right? So the low-hanging fruit play looks like this. It's a former runner that was like this, and then whatever it does, it goes here this day, pop, and then in the next coming days, you have a key level, you know, up here, and this low-hanging fruit this day starts to spike, okay? And you're looking at that level right there. And then it turns out like this, and then like that, right? And so this is the day that we're talking about right here. So when I'm scaling, reference this triangle to this area. Oh, let me redo that. Let me just kind of circle it here for you so it makes more sense. Reference that triangle like that. See? I'm going to start scaling around that area, the midpoint. So I'm going to kind of look at the image and I'm going to say, okay, up to 350, so I'm going to start in that area. But I kind of define it with a little triangle just to kind of get a picture of like how I'm going to anticipate the move is going to turn out. It's going to run up and then die. But again, I'm doing this. I'm shorting into strength. I'm selling into strength always. That's something I think we're getting confused with here. Is that, you know, we're shorting weakness. We're focusing on the backside of a move, which is fine. But don't get in the habit of shorting the bids and slamming it when it's breaking down. That's so dangerous and so easy to get you trapped. Let it confirm and then short the bounce. You got to sell strength, buy weakness. That's like the age-old theory in the market. It is so proven to get the best entries and exits to short or sell strength and buy weakness. It's just what we do. And it works. It works. Don't try to reinvent the wheel. I don't. So, starter, 100 shares, overall size is 500 shares. I dictate my overall size with my starter size. If I start with 200 shares, guess what my size is going to be? Times it by 5. It's going to be 1,000. If I start with 500 shares, guess what it's going to be? Times it by 5. There you go. That's my overall size. whatever it may be, I'm going to use the 1/5 rule. Okay. Now my starter is going to be before I get to my ideal average. My ideal average, I would love to be, short in the 350s. But if I don't miss, or if I miss that, maybe I don't get it. Maybe I don't get all of it. So here's how I do it, and how many people do it. And they may not have a scaling method like I do, but this is how I like to play it out. So I would be shorting in this area here, in this area here, and then up here, and then here, and then trying to get orders up here as well. And those are going to be my 5 orders. And so what I'm going to do is I'm going to split that stuff up. So I'm going to use smaller size further away from my ideal average, okay? And here's how I would do it using range orders. Applying a set risk at all times. If everything goes wrong, applying a set risk. So that if it goes wrong, you don't miss the button and it spikes on you and you're all of a sudden down another 10 cents that you didn't plan for, or 20 cents or 30 cents, and now you're stuck in a halt. Now you're like, fuck. So this is how you can easily do it. It's not tough. It's not tough. It's not tough to do range orders. It's not tough. And you don't even need a thought. It's you. It's in your head. It's where you would like to cover. It's where you would like to stop out. It's not fucking rocket science. It's simple. Simple. And if you don't focus on learning it and you're still asking about stop losses and risk management and this and that, think of this. If you are not consistently profitable right now, if you still have trouble controlling your gains and not giving them back to the market, or you can't find any gains, you can't pocket anything, whatever it may be, you have not deserved the right to use a mental stop loss and to use the Trump hand. Trump hand. Not deserve the right. Not deserve the right. So, I say this. Okay, so hard stops can be used with range orders to get you out of your position. You can scale with these, okay? And I'm going to tell you right now how to do it. Very simple. Very simple. So simple, it's going to be like, what the hell? Okay, watch. Here we go. So, if I'm going to start scaling between 335 to 350 to 370 range, this 40 cent range right here, and I have an overall risk. Let's apply our overall risk. Overall risk here, risk, ideally, is no more than $100, okay? And we're trying to get an average around 350. And we don't want to go above 370. We don't want the price to go above 370 or we stop out, okay? Now, the risk level is above 370 and we want a 350 average. We've said that. So we have 20 cents. 20 cents of range. So 20 cent risk, and that is going to be equal to, 20 cents a share risk equals 500 shares, max size. Okay? So, you always think in terms of risk, every time. Don't short 1,000 shares, cover 500. Short 1,000 more, cover 500. Short, and at any point in time, you don't have a risk level. Because when it goes wrong, and you're sized in way too big and you have 5,000 shares short because you were trying to short 1,000, cover this, short 1,000, cover this, short 1,000. Because what's 10 cents on $1,000? Or 1,000 shares, that's $100. Hell yeah, fuck yeah, I want $100 every time. Yeah, let's do this. No, bad. It's bad. It's so bad. It's so bad because when it goes wrong and you have all these other orders sitting out up there, let's say you got like 3 or 4 other orders up there and they're like 1,000 shares, because, or maybe it's like 500. Or maybe even worse, it's 250, 250, 250. But you planned on taking some profits along the way, but all of a sudden the stock just goes right through all your orders and everything executes. Because you have focused on trying to get small gains in the meantime, you're doing exactly this. You're doing exactly what the market calls eating like a bird. You have eaten like a bird. And when it goes wrong,
guess what you're going to do? You're going to shit like an elephant. Every time. Every time. You're going to have a gut-wrenching loss that just hurts. It hurts inside. But if you scale the move and you don't try to freaking nail everything with size, be like water. Be like water. Move with the price. Keep your size at a manageable level that allows you to move with the price, and you develop a feeling for how the price moves, how the order flow is going along, how the volume is coming in. What does this spike do? Is this, when it breaks this high, does it really have power? Now you got some skin in the game. Now you got a feeling, but you keep your size to a point that is not damaging to your emotions. Because if you're trying to squeeze water out of a rock all the time and use 4,000 shares and make 20 cents and make $800, and you're just like waiting, you're like, and go. And then it goes wrong. And then you're like, fuck. And you just give back 2 days worth of profits. You should never, ever, ever be in a position where your size can give back multiple days of gains if the trade goes wrong. You should never be in that position. Never. If you want smooth sailing, no emotions, just smooth sailing, consistency, smooth sailing. Stay in the game. Stay in the game. Preserve the capital. Keep your emotions at a managed level. Think long term. This is how you have to think. So, now, what I'm going to do is I'm going to use 500 shares maximum, and I'm going to take a starter around 335, okay? In that area, probably like 337, 338, anticipating the 350 level, right? Ultimate risk is 370 because on the chart, there's a wick up there that is 370. It's the high. So if it goes above 370, I'm going to stop out, okay? So here's how your order flow can work. And this is how you focus on low-hanging fruits, right? This is the chart over here. This is the chart. We've identified this is a key level, so we're going to scale into that level with an idea of a diamond shape like that. And we're going to scale this spike. We're going to stop out if it goes above 370. And we're anticipating this move that comes back down because this is a low-hanging fruit play. It generally will conform to its prior resistance and support. Generally will. Resistance more so than support because a lot of the small caps that we focus on were former runners that just like exhausted themselves. And the support or the resistance is more meaningful than the support in all honesty because people that were holding up here are bag holders, so they're trying to get out. So the resistance is more reliable. So now that we have this scaling strategy or scaling method and we have a setup, we have a low-hanging fruit play, we've got a risk, we got a max share size, we got everything we need. We got everything we need. So now let's work on our order book, right? If this is where our order book, this is where our order book, sorry. So let's break it down how we would do it. Let's move this over here. Here's how you can place these orders, okay? And let's say you do this. You do trigger orders. This is how they all look, okay? This is how they're all going to look. Stop. Nope. Sell 100 at 338 at limit 338. Oops, 338. And now this sell is going to trigger this order. So you're going to put in your order box, sell 100 shares at 338 limit, okay? And then in your other order box, that's the other order that gets triggered when this one gets executed. So that order is nothing unless this one gets executed. It can just sit there all fucking day and never get anything. It's got to get executed first. The second order is a range order. Okay, so what you do is you change your stop type to range. So let me put that here. Stop type equals range. And then there's a high price and a low price. Our high price is going to be our stop loss, our ultimate stop, okay? It was just 371. It's a penny above the stop. Oh, it's a penny above high day, which is 370, okay? Or the previous resistance or whatever. We won't stop out if it goes above 370. That's our risk. Okay. Low price, we're going to try to get 20 cents a share out of each of these trades. Okay. Well, let's say you want 10 cents. Who cares? It's up to you. Pick what you want. Let's go 20. Let's go 20 cents. Okay. 338. Now what we're going to do is we're going to put an order down here, 318. High price is 371. Low price, 318. Oh my God, that's such a wide range. No, you're scaling the move. You're scaling the move. But if all goes wrong, you're stopping out for a small loss. You're not eating like a bird along the way. And then if it goes wrong in the end, and you end up shitting like an elephant, giving everything back. And then some. And you have a major fucking red day that gives back other days of profits. Okay? So now, our next order. Okay? These are never even executed. We're going to do sell 100 at limit. Where are we going now, folks? We're going to go 10 cents off the move. Right here. You can do 20. It's up to you. It's up to you. Whatever you choose. Whatever you want to do. If you want to start at 338 and give it some wiggle, go ahead. That's fine with me. Let's say we do that. Now our next order is going to be like 357. Because our starter's at 338. We just want some skin in the game, right? We don't really want to scale around that area. We want 357. Let's go actually to 347. Okay, let's get it 10 cents or 9 cents in this case. And now what we're going to do is we're going to do the same thing. So we're going to copy this stuff right here. We're going to paste it. Stop type equals range. This is our trigger order. This is our next trigger order. We've got multiple trigger orders out there in the market on the same ticker. Okay. Our next trigger order is going to stop out that 100 share, or it's going to execute 100 shares at 347 if it hits. Okay. And our stop time is going to be the range. Remember, if 347 triggers, you got this other order that's hanging out there. Now, guess what happens? Now, if the 347 order triggers, but all of a sudden it tanks down, the 347 order triggers, and you've got an order sitting at 327 already because you're gambling for 20 cents. You're order at 327, you got an order at 318. All of a sudden, you're out. You're out. And you didn't think about nothing. All the order did was just execute. And you just pocketed the profits. You pocketed the profits. You didn't have to think. You didn't think. You didn't go, what's the tape doing? Is the tape slow? Is the tape fast? Is the tape stalling? What is the tape doing? Where's the volume? Where's the resistance? Where's the support? Where's the little notches? Where's the top? Who fucking cares? Who cares? Who cares? You're booking a profit if it comes to you, and you're stopping out for a loss if all goes wrong. There's no emotions. There's literally no emotions. I could put these orders out there, and if the trade comes to me and I know I want to take it, if it comes to me, I fucking walk away. I go to IHOP down the road, give me some fucking breakfast, do whatever the fuck I want to do, eat my pancakes, look at my phone. Oh, dang, I got an order executed. Who the fuck cares? Who cares? Now it's just going to do its thing. I don't have to think about nothing. If it all goes wrong, I have a stop loss in place. If it all goes wrong, I have a stop loss in place. If it goes right, I've got profit targets. Who cares? Whatever can happen, happen. Whatever will happen, will happen. What is meant to happen, will happen. That's a Billions quote right there, folks. Great show. You should watch it. It'll really make you get fucking pumped. Anyway, so now we're going to build our next order. Because remember, we're going to 500 shares. We're going to 500 shares because we're a starter. We're thinking about an overall risk of 100. So our starter is 1/5 of our overall size every time. If we can size with 1,000 shares, then that means that our starter is going to be 200. And we can split it up however you want. You can do 50 shares here. You can do 300 up here. You can do 400 up there. You can do whatever the fuck you want to do. But when it gets to your ideal levels, that's when you start hammering. You're like, and you get your average way up real fast. So I plan these orders. I put them out there. Whatever happens, happens. I don't care. I really don't fucking care. Because I know statistically how it's going to turn out. So now that I have this order out there, I'm going to make another one, right? Because we're scaling all the way to 500 shares. So let's go ahead and let's just do this one. And then we're going to go over here. Oh, that's not going to work. So now our next order, say we scale around 357. It's around the 350 area. Okay. Our stop still, look, our high price is staying the same. The high price is your stop loss when you're short. The high price is your target when you are long. It's your profit number. And the low price is your stop loss. But our low price in this case is our cover target because we're shorting. So now 327 becomes 337. And now we've got sell 100 at 367. And oh no, where our alarm stop is 370. So let's go 363 and 367. Our stop is 371, 337, and now we've got to go another. Is our 40 is our 20-cent range, and we got 47 right here. And there we go. Whatever happens now, we just let it happen. We don't care. We do not care. We don't care. It can do whatever it wants to do. But we have now issued trigger orders for the market to execute if the price comes to our levels. And we don't have to worry about stopping out or taking the profit because there's an order there that already does it. That already does it. You don't have to think about nothing. Don't think about it. Just let it happen. Whatever the market does is fine. Trade your plan. Trade your plan. Make a plan, trade your plan. And quit focusing on the level 2. Quit looking at the price of this or the whatever that and the fucking acceleration and the stopping and the stalling. And the blah, 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 blah. Make a plan first. Now, if you want to hold a piece and you cancel those other orders after you've locked in a bit of profit, that's adding to a winner now, right? Because now, let's say that you get all your executions in a perfect world, okay? And now on the way down, you've gotten all your executions, and all of a sudden the stock tanks to 343. Or no, like 337, right? So when like 367 and went, and you got 3 orders out, all of a sudden you're out. 3 orders, right? You've taken off 300 shares of a 500 share position, and you've made 30 cents a share. That's going to be about $80. No, it's not. No, it's not. It's going to be like $40. 30 cents a share on 300. On the top, no, you're going to have like a 354, 352 average here, I think. So let's do it. 338. And then 347. Just adding the totals here. 357. These are your position values. So this is how you calculate your average in the future. You just add your position values together, and then you go in there and you divide by your overall share size. So those are our position totals. So what we're going to do is we're going to add all those numbers up. I'm going to do that real quick here. 338 plus 347 plus 357 plus 363 plus 367, 1772. So our total position size is not going anywhere. So that is your position value divided by overall share size, which is 500 shares. That's going to be equal to your average divided by 500. It's going to be 354.4. So when it tanks, all of a sudden, you're going to make, from 367 to 347, that 100 shares is going to make you $20. And then 363 to 343, that's going to make you $20. And 357 short down to 337 short or cover is going to make you $20 right there. But anyway, the point here is this, is that, you might lock in 40, $50, something like that. And now you've got a winner, okay? And now your average is 354, okay? So, yeah, this video calls for a glass. Don't judge me. So, because it's the second video. I didn't record on the first one. So now that we've gotten our position, we've gotten orders out of the market, we've got targets, we've got everything. We've got a scaling method, because here's what we're doing. If we want to be sized in, if it gets to our ideal levels, even if that's the front side of a spike like this right here, this is the front side of this spike, but it's the back side of the overall a move. Okay? So don't confuse that. That's from me. Somebody else can say something different. I don't care. That's their opinion. There's a million ways to make money in the market. And I'm not going to say my way is better than anybody else's. I'm just telling you how I do it. So I'm not going to consider this the front side of a move and this the back side of the move. And I'm going to split my orders, one half up here and one half over here, because if I miss this one half, I could have gotten a way better average just shorting this. I'm going to identify the overall backside, the overall downtrend, the overall backside like that, okay? Since it's spiking into this resistance now, that's the backside of the move. I'm going to short all strength into this level right here. I'm going to short strength, and I'm going to cover weakness. Now, if you want to decide to hold a piece for the close to see if it goes lower, or if you want to add back to the winner your shares that you've already covered. Now you're going to add into pops with the ultimate risk again at 370. And you can continue to recycle these orders again with the same stop ranges and everything. You don't need this. Okay, let me tell you what you don't need. You don't need to do this. You don't need to put out an order that's like this. It's like stop market 500 at 371 and then build your position. No. Put like 5 fucking stop losses out there, all with different share counts. Who cares? Maybe different price levels. Scale out of your stop. Maybe only exit half, and then it ends up confirming, and now you add back what you covered. You minimized your risk, and now you've still got skin in the game with a decent average to be able to make back what you already covered. Maybe now, once it's confirmed, you add back and you still have a decent average. And you're not trying to reset your mind every time. Anyway, guys, so hope you guys have a good evening. Hope you guys learned something from this. Have a good night.